I am Jeremiah Ajuda Dusu, the author of Jad's Business and Financial Accounting. Welcome to class again. Okay, we are on the group or consolidated profit and loss account, right? So we're moving forward, right? Okay, so let's take one other aspect here. So it's still so we're looking at okay, all right. So I want to believe that we understand what preference dividend is. Of course, we know that owners of the business, of course, are those that have the ordinary dividends. Okay, and now you can have preference dividends. Of course, preference dividends are, or let's say, preference shareholders. Basically, are shareholders with preference or preferential treatment. Okay, so of course, the ordinary shareholders own the business, right? Ordinary shareholders own the business, and then the preference shareholders are usually ranked before the ordinary shareholders. So it means that sometimes the preference shareholders are even paid, okay? And then the ordinary shareholders might not get something for a particular period. But the idea here is that it is possible to have preference dividends also declared alongside ordinary dividends. Of course, ordinary dividends are for the owners of the business, while preference dividends are for shareholders that have some sort of preferential treatment. And most of the time, preference shareholders, of course, are paid before the ordinary shareholders. So what I'm saying here is that if we have, say, preference dividend, and then we have ordinary dividend, of course, where the subsidiary declares both preference dividend and ordinary dividend. Before now, we've been treating scenarios where only ordinary dividends were declared. Okay, so what do? Usually, we do our schedule up to what? The profit after what? Tax. Okay, so let's say the subsidiary has a profit after tax of, let's say, 100. Okay, and now we have declared preference dividend and also declared ordinary what? Dividend. Usually, if we had declared only ordinary dividend, okay, we would have just what? Taken the part of the what? Minority what? Interest. Okay, so that we can get the profit attributed to the group at the consolidation what? Level. Okay, so let's say the holding company has 90%, the subsidiary has 10%. The minority interest has what? 10%. So what it means is that at this point, minority interest we have 10 over what? 100 times 100, right? Which is what? 10 naira. So that means the holding company has what? 90 of this what? Profit after tax. So this is what we're going to take out of the what? Profit attributable to. So out of the profit at what? CPL level, before we now get profit attributable to the what? To the group. But that is where it is only ordinary dividend. But what happens if we have both preference dividend and ordinary dividend? Okay, so let's say this is the what? Ordinary dividend structure. This is ordinary shares. Okay, so now let's say we have holding company 40%, then minority interest with what? 60%. Let's say this is what? Preference what? Shares. And then we still have profit after tax of what? 100. Okay, so if, for instance, preference dividend declared is 20 naira, ordinary dividend declared is what? Is let's say 30 naira. So what do? Of course, we all understand already that preference shareholders are usually paid dividend before the ordinary shareholders. So that means first thing first, we must take out what? The preference dividend of the preference shareholders from the what? Profit after tax. So when we do 100 minus 20, we have 80. So this is the profit left after what? Deducting that of preference what? Dividend. So it is on this that you can now say for ordinary share, we're going to have minority interest, right? To be what? 10 over 100 times what? 80. Which is this, which is what? 8 naira, right? Now, this 20 naira, remember, it's preference dividend for what? Preference shareholders. Now, this minority has what? 60%. You're also going to do minority what? Interest to be what? 60 over what? 100 times what? 20 over 1. So this cancels this cancels this. 6 times 2 here is what? 12. So that means minority interest is what? 20 naira. This is what is due to minority interest. Okay? So at the CPL level, we're going to take this out of the what? The profit at consolidation what level. So we take it, let's say at consolidation level, we're going to have, let's say, a part of, let's say, 200. Okay? So it means you're going to say less what? Minority interest of how much? 20, which is 180. So this is the profit attributable to what? To the group. Okay? So what I've said here in simple terms is that where you have preference dividend and ordinary dividend, okay, before you take out the share of the minority interest from the profit after tax, you must first of all deduct what? The preference dividend, which I have done here. We have assumed that part is 100, current dividend is 20, so we have 80. So it's on this 80 that we have what? The ordinary share what? Structure to get what? 8 for what? Ordinary share holders. Then on this 20, of course, you're going to have minority interest taking their shares. So their share here is 60% based on this what? Example. So 60% of 20 is what? Is 12. So when you add these two, you have 20. This is what is due to minority what? That will take out here to get profit what? I don't know what? To the group. Okay? So this is it. If you have questions, you can reach my number as displayed. Let's reply with right answers. Let's take a question so you understand what I'm talking about here. Okay, let's quickly take this question so we understand what I'm talking about here. So we have the following represents the income statement of Kings PLC and Queens PLC. So we have it all through down there. Okay, and we have additional information there. Kings PLC acquired 80% shares in Queens PLC on February 2016 when its profit was what? 700,000. Credit balance, okay, 700,000 credit balance. Okay, it also acquired 40% preference shares in our Queens PLC on 31st December 2017. So they say Kings PLC, information to there, sold a machinery of 2 million with a carrying amount of 1.2 million to, sorry, Kings sold machinery of 2 million with a carrying amount of 1.2 to Queens PLC for 2.1 million. The division rate on the machinery is 20%. Queens PLC already charged depreciation for the year. I think I already thought this. I already thought us what's that? Transfer of asset and excess depreciation, right? Good. So you can take that class so you understand what we're talking about here. So let's quickly solve the question here. Okay, so here we have consolidation schedule. So we have Kings, we have Queens, so we have adjustments, then we have CP and what L. Okay, so let's do this way. Okay, so let's go. We have turnover here 40.32. Then what do you have? Cost of sales. What's the cost of sales there? 21,600. We have 17,280. So this will be your gross profit. 18,400. What do we have here? 14,720. We have total expense there. We have 4,600. $3,680. What do we have? Operating profit. What do we have here? 13,800. $11,040. And what else do we have? Other income. Other income here, we have 2,760. 2,208. So what do we have? Profit before tax there. 16,560. $13,248. Then we have what? Tax. What's the tax then? 5,299. Then we have 4,239. We have profit after tax. What do we have there? 11,261. Then we have 9,009. Okay. So we have it here. So what adjustment do we have? From the question, what's the adjustment we have there? We have King's PLC sold machinery of 2 million with a kind amount of 1.2 million to King's PLC for 2.1 million. Depreciation on the machinery is 20%. King's PLC already charged. This is transfer. I already explained that. So what do we have here? So we have carrying amounts of machinery to be 1,200,000, right? So what is the disposal value? It's 2,100,000. So of course, the holding company, which is King's, bought the machinery for 2 million according to the question. They are depreciated. Then as when they sold it, the carrying amount, which is the net value, was 1.2 million. They now sold it to Queens for what? 2,100,000. So there's a profit here. So profit on disposal, that will be 2.1 million minus 1.2. $2.1 million minus 1.2. That's 900. 900,000. Okay. So this, of course, is now. Now, this is a profit that the holding company made on this what asset. So they had already what recorded it under other income. They've already done that. Okay. So it's okay at separate entity level. It's okay. But now we want to consolidate. We want to be one. Do we now say that we sold assets to ourselves and then made profit on ourselves? No, we can't stand, right? So because of the consolidation, we have to eliminate that profit that has been made on that transfer of assets, because as if what was sold was actually sold to us. So if we're not consolidating, then it's okay, the profit has been recorded, that's fine. But now that we are consolidating, that profit that has been made cannot stand, because as if we are making profit on ourselves. Okay? So for that reason, we're going to adjust for this word profit. So the profit has been entered here in other income, but we have to adjust for it. So that means it will have to go out. Okay? Now remember, because we are adjusting for it, that means we are taking the cost of the asset back to what it was before it was sold. Because now it's as if it is now the head office's, first transaction, initial transaction that is going to stand. Since we are eliminating that transaction between the head office and the what? So between the holding company and the subsidiary. So it's like we're taking it back to what it was, which is the first cost that the holding company bought it. The holding company bought it, cost of assets. The holding company bought it for 2 million based on the question. You can check. Yeah. The holding company bought it for 2 million, sold it when it was 1.2 million at what? 2.1. So they made a profit of 900, which they have recorded. But because we're consolidating, we cannot capture that profit. We have to eliminate it. That's the essence of this. But now that we have eliminated, that means we're taking it back to the original cost, which is what? 2 million. So depreciation on this 2 million, they say depreciation is what? Question said depreciation is what? 20%. That's 20 over 100 times 2 million. So this, that's 200,000, right? That is what the head office was charging. So this is 400,000, sorry. That's what the head office was charging, 400,000 per annum. So they already charged twice. For it to not be 1.2 as the kind of, that means they charged twice before they sold it. So now remember that the head of the subsidiary has already charged depreciation based on the question. So subsidiary has done, this is head office. Subsidiary has done depreciation of what? 20 over 100 times 2,100,000. This cancel this cancel this. Okay? So 2 times this, let's say that's 210,000. So if you do 210,000 times 2, that should be 420,000. So this is 420,000. So subsidiary has charged this depreciation already. But because we are not taking this thing back to what it was before, it means that what? This division can also not stand. We have made a profit. So if we make profit, that means this division can also not stand. So that means as if we're taking it back to what? The division that the head office charges. So this is what? 400,000 that the head office would have charged if it was not sold. But it was sold, and then the subsidiary has now charged 420,000. But because we are not eliminating it, we have to now take it back to what the head office did. So it has to be what? 400, not what? 420. Remember, Queens has already charged division and expense, has already charged 420, but we're eliminating the transaction. So we're taking it back to that of the head office. So in that case, what we'll charge is 400, not 420. But because Queen has already charged 420, you have to eliminate the 20,000 excess. So excess depreciation here, right, is what? 20,000. So that has to go out of what? The total expense. So we have 20 here. So what we've simply done here is to eliminate the transaction of transfer of asset from the head office to the what? Subsidiary, which resulted to what? Profit on the transfer and excess depreciation. That is what we have eliminated here. I already took a class on this. Okay? So that's about the only adjustment. So let's consolidate now. So there's no adjustment here. So this will be 40 plus 32. So that's 72. This is 21,600. 21,600 plus 17,280. This is 38,880. So when we take this out, what do we have? 72. So we have what? 33,120. So let's check it at this level. Okay, that's it. So there's nothing here. So at this level we have 4,600 plus what? 4,600 plus 3,680 minus 20. Then we have 8,260. 3,120 minus that's 24,860. So we have 20 here. So check this. What do we have? 13,800 plus 11,040. Okay, plus 20, 24,860. Okay, so at this level we have 2,760. 2,760 plus 2,208 minus 900. So we have 4,068. Okay, 24,860 minus 4,068. So that should be plus. That should be plus. That should be plus 28,928. So we have 28,928. So this will be plus negative. This will be, I think, negative 880. Right? So let's check it this way. 16,560 plus 13,248 minus 880. We have 28,928. Okay, so this our tax. Nothing here. We have 5,299 plus 4,239. 9,538. 9,538. So what do we have? 28,928 28,928 minus 9,538. We have 19,390. This will be 880 negative. So when we test this, what do we have? 11,261 plus 9,009 minus 880. 19,390. So this is profit after tax. Okay. Now remember, we have ordinary share, the ordinary shares here. We have holding company to have how many percent? The question says 80%. Minority interests will be 20%. So preference shares, what do we have? Question says holding company is 40%, minority is what? 60%. Okay? So now we have profit after tax here for Queens, which is for both minority interest and holding company. Remember, there's preference dividend. So we want to know what is the preference dividend. Okay? So what are preference dividend? According to the question, preference dividend declared by the subsidiary is 2,700. So we have, okay, minority interest to be this, okay, minus 2,700 times, okay, what, 20% here. That will be equal to what? 9009 minus 2,700. That's 6,309 times 20 over 100. So what does that give to you? This is 1261.8. Okay, now for preference dividend, for this preference dividend now, okay, we have what now? For that dividend, this dividend is preference dividend. We've taken it out to get that of ordinary shares now. So for the ordinary shares, minority has 20%, which is this. Now for this preference, what is the minority share of this preference dividend now? Because holding company has 40%, minority has 60%. Okay, so that will now be minority interest again will be 60 over 100 times what? 2,700. So what do you have? One six 1620. So total minority interest will be 1620 plus 1261.8. So we have 2881.8. So this is what we have for minority what interest. So at this level now we can prepare the what? The CPRL. So we say Kings and its what? Subsidiaries. So we have consolidated profit and loss or income statement, okay, for the year ended 31st December 2018. So what's turnover now? Turnover is 72. Cost of sales 38,800. And we now have 33,120 is the gross profit. So what do we have? Total expense 8260. We have 24,860. This is what? Operating profit. Then we have other income. Other income is 4068. We have 28,928. So this is profit before tax. So what are our tax? Our tax is 9538. What do you have? 19,390. So this is our what? Profit after tax. So at this level, less minority interest. Less minority interest. That's what 2881.8. 2881.78. So what do we have? 19,390. So we have 16,508.2. So this is what profit attributable to the group. So now we take out what? Proposed dividend of the what? Holding company. So we have ordinary share, we have preference. What's ordinary share dividend? 5068. 5068. What is the one for preference dividend? 3370. So what do we have? 16508 minus 5068. Sorry. 3370. So I have 8070.2. This is what retained profit for the year. So we now say what? Retained profit brought forward, because that's post acquisition, right? So that's post acquisition. So what do we do? So retained profit brought forward. Holding company is what? 3810. Subsidiary will be what? 2250 minus pre-acquisition what profit? That's 2250 minus 700 times what is the holding company's share here? Ordinary share 80%. So that would be 2250 minus 700 as 1550 times 0.8. That's 1240 plus 3810. So that's 5050. So we have 5050. So we add up 8070.2 plus 5, will now be 13120.2. So this is what retained profits carry what? 4. Okay. So what we've done here is to take a question, illustrating, a scenario where there is what preference dividend aside from ordinary dividend. So previously I've been talking about ordinary dividend, but here we have included preference dividend. So we'll talk about how to treat it. Okay, so take your time, go through. If you have questions, you can reach me on the number displayed. I'm ready to reply with the right answers. Don't forget, you can support us. We can the account number displayed or sponsor copies of my textbook. For free distribution. Okay, thank you. See you next class. Bye bye.